Silver didn't rally, it broke the system. In a matter of days, silver didn't edge higher. It ripped from $50 to $90. No warning, no slowdown. And here's the paradox. While the price moved like a crisis, most people still treated silver like background noise, an industrial input, something boring. That disconnect is the risk, because when markets move this fast, they don't adjust. They snap. And when they snap, the damage doesn't stay inside trading screens. It reaches you, your savings, your costs, the prices you pay without realizing why. This wasn't a normal breakout. Traders described a moment where sellers simply disappeared. The order book thinned. Physical metal became hard to source. Prices didn't climb. They jumped straight up. That's what a liquidity vacuum looks like. And here's the part that should make you pause. Moves like this don't usually happen at the end of a story. They happen when something fundamental stops working, when the old price stops being believable. But here's the part nobody is saying out loud yet. This didn't start with speculation. It didn't start with hype. It started when supply quietly stopped behaving the way the world expected. And once that happens, markets don't go back to normal. They move forward fast. What actually happened looks simple on the surface. Silver surged, headlines called it a breakout, analysts talked about momentum, but that framing misses the pattern forming underneath. This wasn't one event. It was a sequence. First, silver pushed through levels that had capped it for decades. Then the speed accelerated, not gradually, all at once, from around $50 to $90 before most people even realized the move was real. That alone tells you this wasn't driven by casual buyers. This was forced behavior. Notice how little explanation initially came with the move. No single announcement, no clean headline saying this is why. Instead, you had fragments, comments about availability, delays, industrial users scrambling. That's usually what happens when a system is adjusting under stress, not celebrating growth. And here's the reframing question that matters. If this were just enthusiasm, why did the market move like it was running out of time? Why did buyers behave as if waiting even a week carried real risk? Because this didn't look like money chasing opportunity. It looked like money trying to escape exposure. And that puts this move into a much larger pattern we've seen before, where prices don't rise because something is valuable, but because something else is becoming unreliable. Now watch how fast this escalates. Because once you trace where the pressure actually came from, the story stops being about silver prices and starts being about control. Here's the claim that changes how you read this entire move. Silver didn't spike because demand suddenly exploded. It spiked because supply stopped flowing the way the market assumed it always would. The concrete detail most people missed came quietly at the start of the year. China moved to require state approval for silver exports. Not a ban, not a press conference, just a rule that instantly added friction to every ounce leaving the country. That matters because China isn't just a miner, it's a refining choke point. Silver from all over the world passes through Chinese processing before reaching global buyers. Once that approval requirement hit, delivery timelines stretched, physical inventory became harder to access, industrial users didn't panic publicly, but their behavior changed. They started covering forward needs aggressively. That's when prices jumped from 50 to 90 without pause. That's the fact pattern. Now notice what's missing. There was no denial that supply was tightening, no reassurance that exports would continue smoothly, no signal that this was temporary. Silence filled the gap, and silence in markets is not neutral. It's interpreted as risk. Here's why that detail changes everything. When a country with refining dominance introduces uncertainty, the market doesn't wait for confirmation. It reprices immediately, not because it knows what comes next, but because it can't afford to be wrong. And this is where the story flips. because once silver became a geopolitical lever instead of a commodity, the move to 90 stopped looking extreme. It started looking like the opening act. Once that lever was pulled, everything accelerated, because this didn't happen in a calm world. It happened against a backdrop of rising geopolitical stress, where uncertainty was already baked into every major market, arrests of heads of state, escalating military postures, open talk of conflicts spreading into energy and trade corridors. None of this caused the silver move by itself, but it poured fuel on it. We've seen this pattern before, not in textbooks, but in moments when markets quietly accept things that would have been unthinkable years earlier. Export controls become normal, resource nationalism becomes policy, strategic materials stop being treated as neutral goods and start being treated as pressure points. What should feel extraordinary starts feeling routine. A government restricts flow, markets adjust, prices spike, then the spike becomes the new reference point. That normalization is the danger, because once markets accept that access is conditional, not guaranteed, they stop pricing commodities for abundance. They price them for interruption. And here's the escalation most people miss. This isn't about one shipment delayed or one policy reversed. It's about the realization that supply chains can be turned on and off with a signature. Once that realization sets in, buyers don't wait for clarity. They front-run scarcity. This is where the story stops being volatile and starts being structural. Because systems that adapt this way don't unwind quickly. They reset. And once a reset begins, the next pressure point is never far behind. Here's the second proof point, and it's more disturbing than the first. Publicly, the narrative stayed calm, no emergency language, no official panic, but underneath, behavior told a different story. Institutions began projecting silver at $130 to $140 an ounce, not as a distant fantasy, as a near-term scenario. That's not something analysts do lightly after a move like this. At the same time, the physical market was already acting as if 90 wasn't enough. Buyers weren't negotiating, they were securing. The move from 50 to 90 didn't cool demand. It intensified it. That's the contradiction. Higher prices are supposed to slow buying. Here they accelerated it. And notice the disconnect. While the metal itself was in uncharted territory, silver equities barely moved. Mining stocks were still being valued as if silver were $40 or $50. That tells you something critical. This wasn't a speculative frenzy chasing leverage. It was a forced repricing of the metal itself, happening faster than financial models could update. Here's the line that permanently changes how you should see this. When the underlying asset revalues before its ecosystem reacts, it means the move isn't driven by optimism. It's driven by necessity. Words said everything was fine. Action said the opposite. And this is where the pressure compounds. Because when fundamentals shift faster than markets can digest, the next adjustment is never gentle. It's abrupt, and it usually catches the most people on the wrong side. Now the pressure stacks, fast. First, supply constraints don't ease. They linger. Approval processes slow flow, inventories thin, and every delay reinforces the same message: access is no longer automatic. Second, geopolitical tension doesn't cool. It spreads. Markets don't need full-scale conflict to react. They just need uncertainty to stay unresolved. Third, monetary conditions keep adding background stress, quietly pushing capital toward anything that feels tangible. None of these developments needs a long explanation. Together they compress time. Decisions that used to be spaced out over months get made in days, sometimes hours. You can see it in how quickly expectations reset. 90 stops feeling extreme. It starts feeling like a reference point. Then buyers begin thinking in terms of what comes after, not whether the move was justified. This is what loss of control looks like in markets. Not chaos on the surface, but speed underneath. Fewer debates, fewer pauses, just reaction stacked on reaction. And here's the question that matters now. What happens if this continues? Because systems under sustained pressure don't drift back to equilibrium. They either find a new balance at a higher level or they force an adjustment somewhere else. Another market, another price, another constraint. And once that process starts, it rarely stops where people expect, now bring it back to you, because none of this stays abstract for long. When silver reprices this violently, it doesn't just hit traders or miners. It shows up in everyday systems, quietly tied to the metal: electronics, energy infrastructure, medical equipment, manufacturing inputs that don't have easy substitutes. When costs jump here, they don't get absorbed, they get passed through. That's how a move in a commodity you don't think about ends up changing the price of things you use without noticing why. Repairs cost more, projects slow down, companies quietly cut somewhere else to compensate. Wages don't adjust at the same speed, bills do, and there's a second layer that's harder to see. When markets realize that physical assets can suddenly become scarce, trust shifts. People stop assuming stability. They start planning defensively, not out of ideology, out of experience. You've seen versions of this before: empty shelves, delayed deliveries, temporary surcharges that never disappear. This feels familiar because it follows the same pattern. A system stretches, then it tightens, then it stays that way longer than anyone expected. If this feels familiar, say so in the comments. Because the most important signal right now isn't panic, it's recognition. And once enough people recognize a pattern, behavior changes, quietly at first, then all at once. To understand why this keeps happening, you have to look past the headlines and into the mechanism. Modern markets run on assumptions. Assumptions about availability, about cooperation, about the idea that supply chains exist to serve demand, not power. As long as those assumptions hold, prices behave. When they don't, prices stop reflecting value and start reflecting leverage. Silver didn't suddenly become rare. What changed is who controls the flow and under what conditions. When access depends on approval, relationships, or geopolitical alignment, the market stops pricing metal. It prices permission. Add another layer. Years of debt expansion and liquidity have trained capital to move fast and defensively. When something real shows signs of constraint, money doesn't debate, it relocates. Not because investors are emotional, but because the system rewards speed over certainty. Mainstream coverage focuses on volatility. What it misses is incentive. Governments are incentivized to weaponize resources. Institutions are incentivized to front-run disruption. Individuals are incentivized to protect themselves before explanations arrive. That combination creates a feedback loop. Control creates scarcity. Scarcity creates repricing. Repricing reinforces control. This isn't chaos. It's a system behaving exactly as designed under stress. And once you see that, the silver move stops looking strange. It starts looking inevitable. The unsettling part is what that implies for whatever comes next. From here, the path splits. Not cleanly, but clearly. One path assumes pressure eases. Export controls soften. Geopolitical risk cools. Markets digest the move. And silver consolidates at a new, higher range. Volatility stays, but the panic premium fades. That outcome doesn't mean a return to old prices. It means a new floor forms, well above where the metal lived for decades. Stability, but at a higher cost. The other path assumes momentum wins, controls remain, supply stays tight. More buyers decide waiting is riskier than paying up. In that scenario, 90 doesn't cap the move, it anchors it. Expectations shift again, and prices chase the next psychological level, not because of speculation, but because access keeps getting harder. Notice what both paths share. Neither points back to the old normal. The debate isn't whether silver should be cheaper. It's how much instability the system can absorb before another adjustment is forced somewhere else. And that's where uncertainty lives. Not in the price itself, but in timing. Because markets don't announce which path they've chosen. They reveal it through behavior, one reaction at a time. Right now, the next move is already forming. You just won't see it clearly until it's already underway. Here's the insight that ties all of this together. Silver didn't move because it became more valuable. It moved because the system that priced it became less trustworthy. That's the shift most people miss. Prices don't just measure worth, they measure confidence. And when confidence cracks, numbers jump. What you're watching isn't a metal story, it's a signal that access, control, and reliability are replacing efficiency as the forces that set prices. Silver just happened to be early. That's why this doesn't end at 90. Whether it goes higher or stabilizes, the reference point is permanently changed. The old assumptions don't come back, they get replaced. And this is the loop to remember. When one market reprices under pressure, others eventually follow. Not because they're identical, but because they share the same system underneath. If you want to stay ahead of that process, not react to it after the fact, follow this channel, because the next story won't look connected at first. It never does. Until it is,